A market crash doesn't create bad traders. It reveals them. And if you've survived one poorly, you already know everything I'm about to tell you. You just haven't built the structure around it yet. I want to start there because I think it changes the entire emotional register of this conversation. If you've been through a crash and come out the other side worse than you went in, if you exited at the bottom, or held losers past every sensible boundary, or made decisions during the chaos that looked obviously wrong, the moment the dust settled, the natural response is to feel like you failed. Like you weren't disciplined enough, weren't smart enough, weren't built for this. And I want to tell you directly that that story, as understandable as it is not accurate. You didn't fail because of a character weakness. You were revealed. The crash removed the conditions that had been masking a pattern that was already there, that had been running in the background of your trading for as long as you'd been doing it, that had never quite caused enough damage in ordinary market conditions to force you to look at it directly. The crash turned up the volume on something that was always playing. And now that you've heard it, even if the hearing was painful, even if it cost you real money and real confidence, you have information you didn't have before. Information about yourself, and information about yourself is the most actionable kind there is. The crash doesn't introduce new weaknesses into your psychology. This is something I want you to really sit with because it has profound implications for how you prepare for the next one. The tendency to exit in panic at the bottom didn't develop during the crash. The difficulty holding a losing position until the thesis actually breaks, rather than until the discomfort becomes unbearable, that wasn't created by the volatility. The impulse to increase position size after a run of losses in an attempt to get back to even quickly, that pattern was there before the first red candle of the crash appeared. What the crash did was amplify. It took patterns that cost you 2 or 3% in normal conditions and turned them into 10 or 20 or 30% drawdowns because it created the specific combination of sustained pressure, real financial consequence, and information overload that removes all the buffers that normally keep those patterns from doing their full damage. The crash is the stress test that the ordinary market never delivers. And stress tests don't create structural flaws, they find the ones that were already there. This matters enormously for how you think about preparation. Because if crashes created new psychological problems, you would need to develop new psychological capabilities specifically for crashes. But if crashes reveal existing patterns that are present and observable in your ordinary trading, just less expensive there, then crash preparation is not a specialized emergency skill. It is an extension of the foundational work of understanding your own psychology in relation to risk and uncertainty. It is built in the same place, with the same tools, with the same quality of honest self-observation. Only the stakes are different. And the preparation that addresses your actual patterns, the real ones, the ones you can already see traces of in your best and worst ordinary trading days, is the preparation that will actually hold when the crash arrives and demands everything it knows you have. Before I walk you through the principles and the specific practices, I want to give you two pictures, two images that I hope will make everything that follows land in a different place than a list of rules would. Because rules, without the right images underneath them, tend to stay in the analytical mind. And the analytical mind is not what fails in a crash. What fails is deeper than that. The first picture is a commercial pilot in a simulator. I want you to really imagine this scene because I think it captures something essential about the difference between prepared and unprepared in ways that a direct description of trading psychology cannot quite reach. The simulator is not a comfortable environment. It is designed specifically to be uncomfortable, to be disorienting, to present the pilot with conditions that their normal training and their normal experience have never produced. Engine failure at 30,000 feet, rapid decompression of the cabin, multiple instrument failures simultaneously, a bird strike at the most critical moment of the approach. These scenarios are staged in conditions of maximum realism, the physical feedback of the simulator, the artificial sounds, the visual representation of an impossible situation because the entire purpose is to put the correct responses into the pilot's nervous system before the emergency arrives in a real aircraft with real passengers. Not because these emergencies happen frequently. Most commercial pilots fly entire careers without encountering the scenarios they train for most intensively. But because when those scenarios do happen, the environment in which they happen removes something critical: the time and the calm required for first-time thinking. The cockpit is screaming. The instruments are contradicting each other. The passengers need something to be true that isn't true yet. The consequences are measured in lives. And in that environment, the human brain, under maximum stress, does not perform its best analytical work. It performs its most conditioned responses. It does what it has been trained to do, repeatedly, until the right response is not a thought but a movement. And the simulator is where that conditioning lives. Now, I want you to hold that image and bring it directly into the trading context, because the crash is the emergency. The market going into free fall, the positions moving against you in real time, the news cycle generating fresh catastrophe every hour, the account balance declining with a speed and a consistency that feels qualitatively different from any ordinary losing day that is the cockpit screaming. And in that environment, you will not be doing your best analytical work. You will be operating from whatever has been most deeply conditioned in your nervous system about how to respond to financial threat. If what has been conditioned is panic and exit, that is what will execute. If what has been conditioned is freeze and hope, that will execute. If what has been conditioned is a clear, pre-decided, specific set of responses to specific scenarios that you have thought through in calmer moments, that will execute. The simulator is the preparation you do before the crash. And the pilot who decided the simulator sessions were excessive, who felt that their general competence in normal conditions was sufficient preparation for abnormal ones, who trusted that their real-time intelligence would be adequate for scenarios they had never actually practiced. That pilot is the trader who enters a crash, having done general preparation but not specific preparation, having understood the principles but not having written the actual answers to the actual questions the crash will ask. And the cost of that gap is paid at maximum pressure, in minimum time, with real money on the line, in a state of cognitive and emotional activation that makes recovery from poor decisions feel almost impossible. The second picture is more personal. I want to describe what genuine crash preparedness actually feels like from the inside, because I think there is a widespread misconception about it that leads people to either pursue the wrong thing or dismiss the possibility entirely. People tend to imagine that being prepared for a crash means being calm during it, feeling steady, experiencing a kind of professional detachment that allows you to evaluate everything clearly while the chaos unfolds around you. And I want to tell you that is not what it feels like. Not for me, not for anyone I've observed who actually navigated crashes well. What it feels like is something stranger and in some ways harder to describe. You feel the loss. You feel the uncertainty. You feel the specific, unpleasant weight of watching real money move against you in real time, on a scale, and at a pace that ordinary trading sessions don't produce. The fear is present. The discomfort is present. The part of your brain that is trying to generate an action, any action, as long as it's an action, is active and loud and persistent. None of that is absent in the prepared trader. What is different is what lies underneath all of that feeling. Underneath the fear, underneath the urgency to act, underneath the alarm signals the nervous system is generating, there is a structure, a foundation of pre-decided answers to questions that were already asked in a calmer moment. At what point does this position's thesis actually break? What specific development would tell me this crash represents genuine structural change rather than temporary volatility? What is the maximum loss I decided I was willing to accept before I made this position a core part of my portfolio? Those answers don't make the fear disappear. I want to be precise about that, because the promise of fearlessness in a crash is a dangerous one. Fear is appropriate information in a genuinely dangerous situation. Your account declining is genuinely dangerous, but the answers give the fear somewhere to go that isn't directly into a trading decision. Instead of the fear becoming the decision, instead of the feeling of unbearable loss directly producing the click to exit, the fear becomes something to evaluate against the pre-existing framework. Is what I'm feeling right now the product of genuine thesis deterioration, or is it the product of intense price movement in an environment of general uncertainty? That question, answered honestly against the criteria you wrote before the crash, produces a very different action than the same question answered by a nervous system operating without any prior framework to check against. That is the inner landscape of genuine crash preparation. Not calm, not detached, not free from fear, but held. The fear is held in a structure that was built in a quieter moment, and that structure is what makes the difference between a crash that reveals your patterns and a crash that activates them without any counterweight. Now, let me give you the principles. The four core truths that underlie crash survival for the traders who consistently navigate them well. And I want to go through each of these slowly and carefully because I think there is significant depth in each one that a surface treatment misses. The first truth is that pre-decided responses are worth more than real-time intelligence in a crash environment. More than, vastly more. And the reason is specific and important to understand. The highest quality thinking you will ever do about a trading scenario is the thinking you do before the scenario is live. This is not a marginal difference in cognitive quality. In a crash environment, your real-time thinking is happening in a state of sustained stress hormone activation, potential sleep disruption, real financial pressure, and continuous information overload from every direction. Your working memory is compromised, your capacity for nuanced evaluation of competing considerations is reduced. Your threshold for deciding that an action is justified is much lower than it would be in calm conditions because the anxiety of inaction in a high-stress environment is physiologically uncomfortable in ways that the anxiety of inaction in a normal market session is not. You are literally a less capable analytical instrument during a crash than you were in the weeks before it arrived. This means that the decisions you make in real time during a crash, however thoughtful they feel, are systematically worse than the decisions you made about the same scenarios in calm prior analysis. The experienced trader who has been through multiple crashes and believes their real-time judgment has improved is not wrong that they've improved. They've improved because they've been through enough scenarios that their preconditioned responses are better calibrated than they were in their first crash. They have effectively been running the simulator in real time over real capital for years. But the shortcut to those better calibrated responses is not more crashes. It is the deliberate simulation of crash scenarios in calm conditions, the deliberate writing of specific answers to the specific questions those scenarios generate, and the deliberate creation of a framework that your crash time self can actually use, rather than having to construct from scratch under maximum pressure. The practical implication is both simple and demanding. Before the next crash arrives right now, in the next week, in the next month, you need to have written specific answers to the questions the crash will ask. Not general principles, not inspiring reminders to stay disciplined. Specific, operational, actionable answers. At what portfolio drawdown level do you reduce overall exposure, and by how much? What specific market conditions or fundamental developments would tell you your macro thesis is broken rather than just tested? What is your maximum loss tolerance per position, defined in dollar terms, and is it built into your actual position management in a way that executes without requiring your real-time permission when the threshold is reached? What would you tell yourself? Specifically, if you were sitting with your largest position down 40% and every instinct was generating exit signals, write those answers. Store them where you can access them when your hands are shaking, because the version of you that wrote them, in calm, with clear thinking and honest analysis, is a better advisor to your crash time self than your crash time self will ever be. The second principle is one that I think is the most structurally important and the most consistently underemphasized in conversations about crash survival. Position sizing is the primary crash survival mechanism. Not prediction, not crash timing, not defensive sector rotation or put options or cash reserves, though all of those have their place. The primary mechanism is the size of each individual position relative to your total capital and relative to your actual loss tolerance. And I want to explain why with enough precision that it becomes real rather than abstract. The trader who is oversized in a crash has no choices. Let me say that again because I think it's one of the most important sentences in this conversation. The trader who is oversized in a crash, who has allocated too large a percentage of their capital to positions that are now moving significantly against them, has no real choices available. The position is too large to hold without the loss threatening the financial stability of the account. The position is too large to hold without the psychological pressure of watching that size of loss in real time, overwhelming the capacity for clear evaluation. The position is too large to add to, even if the thesis is genuinely intact and the price represents an opportunity. The crash, for this trader, is making their decisions for them. They are not trading. They are being traded by the combination of their position size and the market's movement. And the decision they will make the exit at the worst possible moment, the crystallization of the loss at the exact point of maximum fear, is not really a decision at all. It is the inevitable output of having been oversized when the pressure arrived. The trader who is correctly sized experiences the same crash, the same headlines, the same price movements, the same atmosphere of genuine financial uncertainty and real fear. But something fundamentally different is available to them. Genuine choice. The position, because it is sized relative to their actual loss tolerance rather than their optimism about this particular trade, does not threaten the account in a way that removes their agency. They can hold through the volatility because the loss, while real and uncomfortable, does not threaten their ability to continue. They can evaluate whether the thesis has broken or whether the market is simply expressing temporary irrationality, because the psychological pressure of the loss is not so overwhelming that it preempts the evaluation. And perhaps most importantly, they can add to the position if their analysis tells them the price represents genuine value because they have capital available rather than being entirely consumed by managing an oversized loss. Position sizing is how you buy your choices in advance. It is the mechanism that ensures that when the crash arrives, you are still in the position of making decisions rather than being made by them. And the time to size correctly is in ordinary conditions, in the weeks and months before any particular crash, as a continuous discipline rather than a reactive one. Because the trader who re-examines their position sizes when the crash has already begun is the trader whose re-examination is happening in exactly the state of mind that produces the worst outcomes. The third principle brings us back to something I touched at the beginning but want to explore more fully now. Crashes don't create your psychology. They reveal it. And the specific thing this implies for preparation is that the work of crash survival is done in ordinary conditions, not exceptional ones. The pattern that will cost you the most in the next crash is already visible in your trading right now. It may be subtle, it may be expensive in small ways that haven't accumulated into something that demanded your attention, but it is there. The tendency to hold a losing position past any rational exit point, because closing it would make the loss real and permanent, that is there. The tendency to size up after a loss in an attempt to recover faster, which is one of the most dangerous things a trader in a drawdown can do, that is there. The tendency to abandon a valid thesis because the surrounding market environment feels too frightening, even when the specific thesis hasn't actually broken, that is there. These patterns have a specific shape and a specific trigger in your individual psychology, and the only way to know their shape is to observe them in conditions calm enough to observe anything at all. This is why the most important crash preparation work you can do is not technical. It is not about learning more indicators or studying historical crash patterns or developing a better hedging strategy. It is the work of sitting down honestly and without self-judgment and looking at your trading behavior in your last significant period of drawdown or stress. Looking at the specific decisions you made and asking not whether they were right or wrong, but what emotional state produced them, not the justified analytical story you constructed after the fact. The actual emotional state that preceded the click, the actual feeling that made the action feel necessary. Identifying that feeling, naming it, tracing it to its source, understanding the specific market conditions that reliably activate it is the preparation that no course can give you because it is entirely specific to you. And it is the preparation that matters most when the next crash arrives and attempts to activate that same pattern at maximum intensity. The fourth principle is the one that I think produces more in-crash errors than any other single confusion, and it is this. The story of the crash and the story of your specific trade are not the same story. They are related. They are happening simultaneously, but they are not the same and acting as if they are making decisions about your specific position based primarily on the general emotional weight of the crash narrative is one of the most expensive mistakes a trader can make during a market disruption. Let me explain what I mean precisely. During a significant market crash, two things are true simultaneously. The first thing is that a macro event is unfolding an economic disruption, a systemic risk event, a loss of confidence in some broad class of assets or in the overall market structure. This event is real. The fear it generates is appropriate information. The volatility it produces is not manufactured. And the general advice to reduce exposure, manage risk, stay close to your pre-decided parameters, all of that applies to the macro situation. The second thing that is true simultaneously is that you hold specific positions with specific theses that were built on specific analyses of specific companies or assets. Each of those theses either holds or it doesn't. Each of those theses is either supported or contradicted by the specific information the crash is generating about that specific asset. And these two stories, the crash story and the trade story, have to be evaluated separately. The confusion happens when traders use the emotional weight of the first story to make decisions about the second. When the crash is frightening enough, and the news cycle is relentless enough, and the market's downward momentum is consistent enough, the macro fear can feel like sufficient reason to exit any and every position, regardless of what the specific trade thesis says. And sometimes that is the right call. Sometimes a crash is systemic enough and prolonged enough that every thesis is compromised. But often it isn't. Often the crash is temporary, driven by sentiment rather than fundamentals, and the specific theses that were valid before the crash remain valid during it and after it. The traders who sell good businesses at crash prices because the crash feels like sufficient reason are not making trade decisions. They are making emotional decisions dressed in the language of risk management. And the cost of that confusion, of exiting a valid thesis at a crash price and then watching the recovery happen without you, is one of the most expensive and most recurring patterns in individual trading and investing. The practice of separating these two stories, the crash story from the trade story, requires having written specific criteria for each position that tell you, before the crash arrives, what would actually break the thesis for that specific position. Not the market falling, not the sector declining, not the general atmosphere of uncertainty. What specific fundamental development, specific competitive change, specific financial deterioration would tell you that the thesis you built is actually wrong? When you have those criteria, you can evaluate the crash's information against them with real precision. You can ask, is what is happening right now actually one of the things I pre-identified as thesis breaking? Or is it the market's general fear creating price movement that doesn't reflect anything real about this specific asset? That question, answered honestly against specific criteria written in a calmer moment, produces a very different decision than the same question answered in the middle of maximum crash panic with no prior framework to reference. Now let me give you the three practices, not abstract principles about crash preparedness. Specific, concrete things you can begin this week that will change what you have available when the next crash arrives. And I want to be clear that these practices are not the complete work. They are the starting point. The preparation that matters most is built across years of honest self-observation and consistent structural discipline. But these three things are where that longer work begins. The first practice is to write your crash scenario responses in advance. Tonight or this week, take 30 minutes for each major position or strategy you currently hold and write specific answers to three questions. The first question: at what percentage loss does this position's thesis actually break, not become uncomfortable, not trigger anxiety, but actually break based on what I understand about the underlying asset? The second question: what is the maximum loss in dollar terms that I am willing to accept on this position before I exit, regardless of my thesis conviction? Because the practical or psychological cost beyond that point is not worth the potential recovery. The third question: what specific market development, not price movement, but actual fundamental or structural development would tell me that this crash is something my thesis didn't account for rather than something it already priced in? Write those answers specifically and honestly. Not the answers you wish were true, the answers that are true based on your actual analysis and your actual risk tolerance. Store them somewhere you can physically access in a moment of crisis, not buried in a folder, not in a note you'd have to search for, but somewhere that is as accessible as your trading platform. Because the version of you that wrote those answers, in calm, with clear thinking, is the advisor your crash time self needs most and is least likely to be able to find if they have to construct the advice from scratch in real time. The second practice is a position size audit, not an intention to do one eventually. An actual audit this week of your current portfolio. Go through each position and ask one question. If this asset declined 50% from today's price, what would the dollar impact be on my total capital? Then ask the follow-up. Is that dollar impact one I could genuinely absorb financially and psychologically while maintaining the capacity to evaluate the position clearly and make rational decisions about it? If the answer to either part of that question is no, if a 50% decline would threaten your financial stability, or if it would produce a level of psychological pressure that you honestly know would compromise your decision-making, you are oversized. Not by a little. Structurally, and the time to address structural vulnerability is right now, when the market is giving you the opportunity to make orderly adjustments rather than forced ones. Because the crash will eventually arrive, and when it does, the trader who is correctly sized will have choices. The trader who is oversized will be managed by their positions rather than managing them. That difference between having real choices and having choices made for you is the primary structural outcome of position sizing, and it is entirely within your control to determine which category you're in before the next disruption arrives. The third practice is the one that requires the most honesty and produces the most direct impact on what actually happens in your next crash. I want you to identify your specific psychological crash pattern. Think back to the last significant market disruption you experienced. Not what the market did, what you did. Not the justified story you constructed afterward, but the actual sequence of your decisions and the emotional states that produced them. Did you exit positions at a point that felt necessary in the moment and obviously wrong in retrospect? Did you hold losers for longer than any sensible framework would have justified because selling would have crystallized a loss that staying open kept theoretical? Did you stop checking your account entirely because the anxiety of watching it was unmanageable, which meant you missed the moments when your intervention would have actually helped? Did you increase your position size in a declining market in an attempt to average down in a way that turned a manageable loss into a significant one? Identify the specific pattern. Name it as precisely as you can. Give it a short description that captures its essential character. And this is the part that takes the most from you, write a one-paragraph instruction to yourself that addresses that pattern directly. Not a motivational paragraph, not a reminder to be more disciplined. A specific, concrete, situation-addressed instruction. When I feel the urge to do X, here is what I will do instead. And here is why that alternative is better aligned with what I actually know about this situation. That instruction, written in your own words, grounded in your own experience of your own most costly pattern, is the most personalized crash preparation tool available to you. It costs nothing except the honesty to look clearly at what happened last time, and it is worth more in the moment of maximum pressure than any general principle, because it is specific to you, because it speaks directly to the thing that your specific nervous system does under specific conditions. That specificity is what makes it hold when the general instruction to stay disciplined would dissolve under the weight of real fear. Let me bring this home. Let me bring together everything we've covered and leave you with something that holds its shape. We started with a reframe that I hope changed the emotional texture of this entire conversation. A crash doesn't create bad traders. It reveals them. And that revelation, as uncomfortable and expensive as it may have been the last time you experienced it, is not a verdict on your character or your capability. It is information. Specific, actionable information about the patterns that were already present in your psychology, that ordinary market conditions kept from doing their full damage, and that maximum pressure finally amplified enough to make visible. And visible patterns are patterns you can work with. We looked at the pilot who skipped the simulator and the crash conversation the prepared trader has already had with themselves. We built 4 principles: that pre-decided responses vastly outperform real-time intelligence in crash conditions, that position sizing is the primary mechanism of crash survival, not prediction, because it's what determines whether you have real choices during the crash or whether the crash is making your choices for you. That crashes reveal rather than create psychological patterns, which means the preparation work lives in ordinary conditions rather than exceptional ones, and that the crash story and the trade story must be evaluated separately with specific pre-written criteria for each position to avoid the catastrophically expensive confusion of using macro fear to make micro decisions. And we ended with 3 practices: the written crash scenario responses that give your best thinking a way to survive until your most pressured moments, the position size audit that determines right now whether you'll have choices in the next crash or whether you'll be managed by it, and the specific psychological pattern identification that produces the most personalized, most directly actionable preparation available to you. You don't need to see the crash coming. The traders who prepared best never claimed to see it coming. They built something better than foresight. They built a system that didn't require foresight, a system with pre-decided answers to the questions the crash would ask, with position sizes calibrated to genuine loss tolerance rather than optimism, with honest knowledge of their own specific patterns and specific instructions for managing them when the pressure was loudest. You are not fragile because crashes frighten you. You are human, and they frighten everyone who is paying genuine attention to the reality of what is happening. But frightened and prepared are not opposites. You can feel the full weight of a crash, feel the genuine fear that real money moving against you in real time deserves to produce, and still have a structure underneath that feeling that executes correctly. That structure is the difference. Not courage, not the absence of fear, structure. Build it now, in the calm, because the calm is where the real preparation lives. And what you build here in these ordinary moments, in these sessions that don't feel urgent, is exactly what you will have available in the sessions that feel like everything. If something in this conversation landed for you, if the pilot image clarified something, if the pre-decided responses idea is something you're going to actually do this week, if naming your specific crash pattern put language to something you've been carrying since the last time the market tested you, leave it in the comments. I read them. I want to know what reaches people and what I need to go deeper on next time. A like takes 2 seconds, and it helps this reach a trader who is sitting in their first significant crash right now, today, trying to figure out how to navigate what they're feeling. Maybe they need to know that the structure can still be built, even now, even mid-crash, even when the preparation didn't happen first, because it can be. The foundation is always better built before the storm arrives, but a foundation begun in the storm is infinitely better than no foundation at all. And if you want to keep building this, not just crash survival, but the complete psychological architecture that makes consistent, durable, genuinely excellent trading possible over a lifetime, subscribe. This is the work I'm here to do with you. One clear, honest, unhurried conversation at a time. The crash doesn't decide your outcome. Your preparation does. And preparation starts right now, not when the next crash begins. Now, in the calm, where your best thinking lives and where the structure that will hold you gets built. Let's build it.